We are going to discuss, or in fact, compare two standards. One is your IAS 16, which you call PPE, property, plant, and equipment, and the other one is IAS 40, which is investment property. Of course, I'm not going to, explain both of these standards because we already have covered them in separate lectures. Here we are only going to make some comparisons, some differences, and then we will see how do we treat measurement methods, initial measurement and subsequent measurement, and then we will see how do we treat the gains and losses under the two standards. So this is the agenda. So, I mean, we are not going to completely explain everything because we already have covered that. It's just like a recap and a comparison. Now, IAS 16 property, plant, and equipment, these are tangible non-current assets. Common examples are land and building, motor vehicles, plant and machinery, furniture, fixture, computer equipment, etc. So quite a lot of tangible non-current assets, starting with land and building and plant and machinery. Under IAS 40, you have only investment property, and that is only land and building, and that's all. That's all. Property, investment property, IAS 40 is land and building. Now, the question is that land and building comes in IAS 16 also and IAS 40 as well. So land and building is in PPE and it is also in IAS 40, investment property. The difference is that one of the conditions of IAS 16 PPE is that the asset must be used within the normal course of business, okay? This asset is used in the provision of goods and services or for the administration purposes. So IAS 16 requires that asset must be used in the normal ordinary course of business. So if you have an office, a land and building, which you are using in your business, so that is treated under IAS 16, property, plant, and equipment. But if you have another office or a premises or land and building, which you are not using in the ordinary course of business, but you have kept it with an intention of, capital gains over a longer period of time, or you want to get a rental income by giving it on rent, so you are not using it, then you treat it as investment property. I'll start with a very short example. Let's suppose that this is some business center, this is some building. In that building, you purchase this one office, which is on, 6th floor, and you paid 100K for that. And then you purchased another office also, which is on the 4th floor, and you paid 100K for this as well. And then I ask you that, what are you doing with this office? And you say, this office, I've set up my own company, my own business, maybe a cargo company, a freight forwarding company, maybe a consultancy, whatever. So I'm using this as my office. I have my own company and, my people, my staff, and I, we work from here. So if you are using it in your business for that particular business, like the business name is ABC company, okay? So ABC company owns this office. So this office is used by ABC company for provision of its services. You treat it under IAS 16. And then you have got this ABC company also owns this office. So this ABC company purchased two offices, same value in the same building. And I say, what are you doing in this office on the 4th floor? Are you doing your operations from there? You say, no, we are not using it in our normal course of business. This is not under our use. We actually purchased it. Maybe we will give it on rent and we will earn some rental, or maybe we will just keep it for some period of time and then we'll sell it to make some capital gain when prices will go up. So it means that this is not for your operational purposes. This you purchased for investment purposes. So this is called IAS 40. So now both offices having the same value within the same building, owned by the same company, but the accounting treatment will be different. The first one which you are using is IAS 16, which is PPE, excuse me. And the second one is investment property, IAS 40. So this is the first thing which you need to understand. Now, this is one graph or one chart which you can see on your screens. And I have put here the standard. This is your PPE IAS 16, and this is your investment property IAS 40. There are many other assets as well, like intangible IAS 38, financial assets IFRS 9, biological IAS 41, defined benefit IAS 19, inventory IAS 2, but we are not going to discuss them. We will only focus on these two. This first circle is for your initial measurement, which means that when you acquire the asset. And the outer circle is for your subsequent measurement, which is on the reporting date. So if I speak about PPE, the initial measurement is at cost. And I'm sure that you people already have covered IAS 16. Cost means, purchase price plus all other expenses which are incurred to bring the asset to present location and condition, which means transportation, installation, all direct expenses which were necessary to bring the asset in the up and running condition. That is called cost. So when you bring the asset, you measure it cost. And then at the end of the year, IAS gives you two options. Either you use the cost model, the CM means cost model, or you do the revaluation model. Revaluation model is RM. So either you are measuring it at cost model, or you will measure it at cost revaluation model. Now, what is the difference, the cost and revaluation? Cost model means that your initial cost, which was your historical cost, minus your accumulated depreciation, and minus your any impairment losses. So this is called cost model. I purchased assets for 100,000. So far in 2 years or 3 years, there is a 40,000 depreciation and 60,000 is my net book value. This is my cost model. And next year, again, 20,000 depreciation, and then the asset becomes 40,000 net book value. And if there is any impairment, you should subtract that impairment also. This is called cost model. Under revaluation model, it is quite similar. The only difference is that revaluation model, you don't say cost, you say revalued amount. whatever it is, minus accumulated depreciation, minus any impairment losses. So revaluation means that, first you should understand that cost model is an entity specific measurement, which means that I purchased asset for 100, and then I suppose that there will be a 20,000 depreciation every year. So I subtract 20,000 year one, subtract 20,000 year two, and subtract 20,000 year three, if I'm using straight line method. And I say that end of the year three, the asset has a value of 40,000 net book value, or you also call it carrying value or carrying amount. Now, this estimate is entity specific. This is my own estimate. It has got nothing to do with the market. Maybe in the market, the asset has more value, maybe it has less value. Okay, I'm just seeing my own estimate, cost model. I purchased this much. This is my estimate of depreciation, and I just show it there. When you speak about revaluation model is market specific measurement, not entity specific, but market specific. So for example, at the end of year three, your net book value is 40,000. Maybe in market, the revaluation is different. So IAS gives you this option. Either you take the cost model and continue with 100, 80, 60, 40, 20, 0 in 5 years, or you do revaluation. Now that's the company policy. It is your choice. Either you use cost or you use revaluation. If you do revaluation model, which generally you should be doing, because IAS says that all significant assets should be revalued every year. So if you are doing revaluation method, you will revalue the asset according to the market. And then after revaluation, of course, the new value will come, maybe 100, maybe 110, maybe 120, whatever it is. And then you will calculate new depreciation. And then again, so revalued amount minus accumulated depreciation minus impairment. So accumulated depreciation and impairment, this is the same thing. The only thing is that should I be subtracting accumulated depreciation from cost or from revaluation model or from revalued amount? So under revaluation model, you use revalued amount. So these are the two options. And IAS says for IAS 16 PPE, you can use any one of them. Quite simple. And by the way, it is not the topic, but just for the sake of discussion, this is intangible, which is IAS 38. It is exactly the same way. Okay. Under IAS 38, exactly the same treatment. Initial at cost model, subsequent either cost or revaluation, and same type of depreciation, straight line, reducing balance, and same impairment stuff. So you can consider that if you understand IAS 16 measurement and treatment, IAS 38 is also the same. IAS 38 is, by the way, intangible, non-current assets. Then comes our topic, which is investment property, okay, IAS 40. Now, in IAS 40, what happens? Now, we understand that IAS 40 has to be a property, land and building. And initially, it will be measured at cost. And we are not, by the way, using it in the normal course of business. It has been kept for the sake of, so for IAS 40, you take the initial measurement at cost, just like your IAS 16. And again, the cost method is the same, like whatever cost you incur for the asset, okay? It might include some legal costs or, acquisition cost, etc., purchase price, you add all of them. But then what happens that the subsequent measurement, end of the year, either you do it at the cost model or you do it at the fair value model. Now, here there is a trick, okay? You do revaluation model here. And here you have fair value model. You don't have revaluation model in IAS 40. Now, one thing is for sure. Now, you need to understand, in IAS 16, property, plant, and equipment, IAS says it that you can use either cost model or revaluation model. Both options are available, although preference is given to revaluation. But in IAS 40, investment property, fair value model is kind of, required or desired or highly recommended. Generally, we should be using fair value model. And fair value means the same market value. So fair value, again, is an entity-specific measurement. And what happens in fair value model that you don't do depreciation. So in fair value, there is no depreciation. And by the way, there should not be for investment property. Why should I be doing depreciation? The concept is that if it is an asset which I'm using in my business and it is IAS 16, the asset is bringing some revenue and also the depreciation. So revenue and depreciation, they both go to the income statement. But in case of investment property, I'm not using it in my ordinary course of business. So why should I be taking its depreciation? I'm not using it. So you don't charge depreciation. What you do that you see that how much was your fair value last year? Last year, the fair value was 100. This year, the fair value has become 110. And this $10, this is the increase that should be recorded. Just like if you have under cost model, let's suppose if I'm using my cost model, my asset is 100 and it increases to 100. Okay, I'm not sorry, under cost model, under revaluation, if I'm doing, so let's suppose that I'm doing my revaluation model and the asset was 100 and it goes to 110. And all the other side, I have my fair value model. The asset was 100 and it goes to 110. Okay. So this $10 increase, you should remember that this $10 increase, this should go to OCI, other comprehensive income. Remember OCI, the part which is below profit and, below that operating profit after tax, and then you add other comprehensive income to make it total comprehensive income. So any gain in under IAS 16, it goes to OCI. Why it goes to OCI, I will explain. Any gain under IAS 40, you also have a gain of 10, but this $10 gain will go to P&L. Now, what is the difference? I mean, why do we do that? I will explain you. So first you remember that under IAS 40, we don't charge depreciation because IAS 40 generally is done on fair value. If it is done on fair value, there will be no depreciation. Only difference in changes, the difference in the fair value, beginning and closing fair values, they are debited or credited to your P&L. Okay, now what if you are doing IAS 40 with cost model? Because it is possible that in some particular situation, you have an investment property and you cannot do fair value because there is no market value available. You can get the asset does not have active market, so you cannot find the price from the market. In that case, you can use it for cost model. So if you use it for cost model, now do you depreciate it or not? Many times students, they, because one idea in mind is that IAS 40, there is no depreciation. So if I'm using it at cost model, should I charge depreciation? Yes or no? IAS 40 clearly does not say that you should charge depreciation or not. It does not, it is not written, explicitly. But IAS 40, it does say that if in a situation you cannot use fair value model, then you use cost model just as it is in IAS 16. So it says that use cost model as it is used in IAS 16. And of course, in IAS 16, cost model means depreciation should be charged. So it means that if you are doing IAS 40 measured at cost model, which is very rare, then you should be doing depreciation also. So this is important thing to remember. So let me make a quick summary. I have to speak many things more, but let me just recap what we have done so far. Both are land and building. If land and building is used in the business, IAS 16, cost model, revaluation model, cost minus, accumulated depreciation minus impairment losses, whatever. If it is investment property, cost model in the beginning and end of the year, either cost or fair value. And if it is fair value, then no depreciation will be charged. And if it is cost model, then depreciation will be charged. This is one. Gains and losses on IAS 16, they go to OCI. Why they go to OCI, I will explain. I will not ask you just to remember it. I will explain you why. And gains and losses under fair value model should go to P&L. Okay, so that is clear. Now, one thing, why do we measure it at fair value? Why we measure it at fair value? See, under IAS 16, you are using the asset, and you are many times you are measuring it, the subsequent measurement, the ending measurement, reporting period. You do at cost model, and sometimes it seems okay. Because we don't have any intention of selling the asset. Okay, so I'm not selling the asset. It is in my books, and I'm going by the books. But if you are talking about investment property, why did you buy this investment property? You buy the investment property with an intention of making capital gains, which means you might be selling it. So if you are selling it, where will you sell it? You will sell it in the market. So please take the market value. Okay, if you are living in a house which you have no intention to sell, you are not checking its market price because you are not planning to sell it. But if you have a house which is for investment purposes, so definitely end of every year you do want to see that how my investment is doing. And how do you see how my investment is doing? By comparing it with the market. So you make it fair value measurement. You take it at fair value because this is something which is the market specific thing. So that's why you take it to fair value. The second question is why it goes to OCI and why, the IAS 16 gains and losses, we show it in OCI, and IAS 40 gains and losses we show into P&L. For this thing, let me share with you one more slide. And actually there is one lecture which I have, a separate lecture on how to say structure of statement of comprehensive income. I explained it somewhere in one of my previous lectures. That's a 30-minute structure, very important lecture. I'm not going to repeat all of that, but in brief, I will tell you that this is the line, this PBIT, okay, I just drew it wrong. Let me call it like this. This is the line. This is the part where you call it operating part, and this is called operating income. This part is actually managers are responsible, okay? The managers are responsible for this part. Like revenue, it is because of their effort. Costs, it is because of their decisions. And this is the profit, which is the reflection of the management's performance. I would say that this PBIT is the line, this is the number at which the manager's performance is measured. And this is the reason that whatever type of financial statement interpretation you do, you always do interpretations at this number, okay, PBIT. In all your calculations of ratios and others, you never use profit after tax, okay? We don't use this thing because we believe that this finance cost, which is interest expense, and this tax expense, these are beyond the control of the manager. These are market economy specific thing. In some economies, interest rates are more. In some economies, taxes are more. In some economies, taxes are less. So managers should not be punished or penalized because of the higher taxes or higher interest rates. We want to see how much they are earning from operations. So managers are responsible for this part. And then you have other comprehensive income. And after this thing, after this line, this is totally another thing, other comprehensive income. Now, the question is, what comes into other comprehensive income? If you make a gain on Forex gain or loss, gain or loss on sale of or disposal of non-current assets, where do we treat them? Now we know that this part is responsible for this comes under the responsibility of the managers, and OCI is a different treatment. If you see IAS, in IAS it is not very clearly written what comes in OCI. It is not like very clear advice is not given. What they say that usually what you do that in OCI you put unrealized things, okay? You put unrealized gains and losses. This is what is the guidance given. unrealized gains and losses. Unrealized means that gain and loss has happened, but it has not been realized because you might not have sold the asset, or you might not have incurred that gain or loss. And it is possible that next year the property value may go down, may go up. So when you make a gain or loss on IAS 16, you put it here. You put it here in OCI because it is unrealized gain and loss. You are sitting in an office, the value of the property goes up or the value of the property goes down. There might be some gain, there might be some loss, but it does not impact you straight away because you are not selling the property in any case. So today you might have made a gain on this, non-current asset as a result of revaluation. Tomorrow maybe impairment will happen. So let's keep it in OCI. Okay, let's keep it in OCI, the unrealized thing. Now I understand that in IAS 16, my gains and losses, they go to OCI, because these are unrealized. And then I say that IAS 40, gains and losses, they go to P&L. By the way, they are also unrealized. In IAS 40, these are also unrealized. I have got this two offices, like I told you, for 100K and 100K in the same building. This goes to 110. This also goes to 110. This I am not selling. This I have also not sold yet. So this is also unrealized. So if both are unrealized, why do you put one in OCI and one in the P&L? Here you need to understand a second criteria. In OCI, like IAS tells you that put the unrealized things, but I have another understanding also. Another understanding is that in OCI, you put those things which are beyond the control of the manager, which are not the result of the activities of the manager, okay? So that the managers do not take credit for them. I put here two types of things. One is unrealized and one is beyond the control of manager, okay? Manager is controlling only until here, okay? So let's suppose that as a manager, let's suppose that your profit is zero. Operating profit is zero, but then you made a gain on property of 100K. And you come back and say, the company made 100K. Yeah, the business made 100K, but you made zero. So don't take credit of this 100, because this 100 was not as a result of your activities. This was not the result of your, decisions. So in OCI, remember two things: unrealized and beyond the control of the manager. Now, when you have IAS 40 PP, you have IAS 40 investment property for 100K, and it goes up to 110. This 110, you made a gain of 10,000, okay? Now, I say that this gain should come here in P&L. It should not go down because now that's the point to understand. You had a business of freight forwarding and you purchased one office on the 7th floor or 6th floor. Then why did you purchase office on the 4th floor? I mean, you never needed it. The money was lying in the bank. You as a manager took a decision, you perceived or you expected that the prices will go up and you wanted to make an investment. So it was your decision to take out 100,000 from the bank and purchase this property. So if this property value goes up or if it goes down, you should either be penalized, or you should be able to take the credit that this 10,000 was a result of an investment property, and investment property was not the ordinary course of business. It was my specific decision. I took the decision of buying the property, and therefore I should be credited with 10,000 here, so that when you do interpretation of my ratios, I get the benefit. Otherwise, the money was lying in the bank. So that is the reason that in IAS 40, when you make gain and loss, you charge it to P&L, because that was the investment decision made by the management. If the value goes down, maybe it goes down to 80, then you put a 20 loss, and then you ask the manager, come in here, please. Why did we make this loss 20,000? Oh, we purchased this office. We never needed this office. Who took this decision? You took this decision. We never needed this office. You made a bad investment. And when you made a bad investment, this loss should be shown in P&L. And when we do interpretation of financial statement, when we measure your performance, you should be hit. Your performance should go down. So this is the reason why you took IAS 40 under P&L and IAS 16 under the OCI. So we are clear on this thing, okay? Gains and losses. Any gains and losses, they go to OCI for IAS 16, and here any gains and losses for IAS 40. Now, it is also possible sometimes that you might have an asset which is in the beginning you were using. So this from January to June, you were using the office, okay? You were using the office. And then from the next period, June to December, you just rent it out. You stop using it, okay? You stop using it, you rent out the property. So for this period, this asset is IAS 16. And for this period, 6 months, the asset is IAS 40. Here, you will calculate depreciation for 6 months. And here, there should be no depreciation for the next 6 months. So you should draw the line when the asset changed its status. For 6 months, it was IAS 16. I was calculating depreciation, 6 months depreciation will go to P&L. Then from 30th of June or from 1st of July, the status was changed. The asset was classified as IAS 40 investment property. And for the last 6 months, there is no depreciation, and I will measure it at fair value, any changes. And you should also be measuring fair value here in the beginning. You measure fair value at the end. And if there is any difference in the fair value, that should go to P&L. So this is sometimes the asset change status during the year. It is also possible that you might have a bigger asset. Let's suppose you have a building, and on that building, this is floor 1, floor 2, floor 3, floor 4. So 1, 2, 3, 4, and 5. There are 5 floors. You are using this floor, 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 and you rent out this floor. If it is the same value, I can say that if the asset is for, let's suppose, I don't know, these are 5 floors. So let's suppose asset is for 50 million. So let's suppose this is 20% of that, which makes it, only 10 million. So 10 million here and 40 million here. Okay, this 10 million should be done under IAS 40, and this 40 million should be done under IAS 16. So you do proportionate. In some cases, if like you have a bigger office and a very small part is rented out, which is immaterial, maybe 3% or 5% of your premises you rent out, then you can ignore the separation. But if it is more than 5 or 10% thing, if it is more than 10%, it is material, then IAS tells you that you should proportionate it. 50 million, 20% of 50 million will go as IAS 40, and 80% of 50 million should go as your PPE. This is my PPE, this is my investment property, okay? And this will be depreciated, and this could be used at cost or revaluation model, and this will not be depreciated. This could be done on fair value model, or maybe at cost, but preferably at fair value, okay? So you can separate it. And there are some questions also on this issue where you have an asset, and we can actually create some question by ourselves as well. Like, this, whatever the value here, it is 40 million, whatever is the life of the asset, you will depreciate it. Let's suppose that there is some land inside. So land you do not depreciate. Out of 40 million, let's suppose out of 40 million, 10 million is land, and 30 million is building. Okay, so I know that in PPE IAS 16, land and building, land we don't depreciate, building we do depreciate. So you will be calculating your depreciation only on 30 million. This land will not be depreciated, this investment property will not be depreciated. So in the books, the asset is 50, separated 10 million as IAS 40, no depreciation, 40 million as IAS 16, depreciation. But out of 40, 10 is land, again, no depreciation, 30 is building, I should be doing depreciation. And of course, the number of months. And this 10 million, which was my investment property, I will check the fair value at the end of the year. Let's suppose they say that this 50 million property, it goes to 55 million, okay? If they tell you that 50 million property becomes 55 million overall, so you can see that there is a 10% increase. So if there is a 10% increase, then this 10 million will become 11 million, 10% increase. So as a result, 1 million will go to P&L, okay? 1 million will go to P&L. Under this scenario, 50 million total property becomes 55, which is a 10% increase. 10 million was my investment property portion. 10% increase means 10 becomes 11. So 1 million goes to P&L as your gain. 1 million will go to P&L as a gain, and the depreciation of this 30 million will go to to your P&L as your depreciation expense, provided you were doing it on cost model. If you were doing it on revaluation, then it will also have a revalued amount, and revalued amount will go to the OCI part. So this is about your how to say IAS 16, IAS 40, a little bit of comparison. There is one more thing, by the way. One last point I will tell you, that let's suppose that this is a building, okay? I'm just making again. This is one office you purchased, another office you purchased, another office you purchased. What are you going to do it? I'm going to use it. What are you going to do it? I'm going to rent it out. So I'm going to use it. This is my IAS 16. This is my IAS 40, okay? Investment property. What are you going to do with this one? I'm not sure. You will say that I'm going to sell it, okay? I'm going to sell it. I'm going to sell it anytime now. This is your IAS 2 inventory. IAS 2 inventory. IAS 40 investment property, you will only treat when you do not have any intention of selling it in the near future, when you are doing it for a longer term period for capital gains. But if you are buying it with an intention of selling it, like you purchase it and then you immediately start looking for its customers, which means that it is available for use, which means that it is with the purpose or intention for selling it, it becomes IAS 2, which is inventory. So all three of them are offices, all three of them are in the same building, but their accounting treatment will be different depending on the purpose or the intention for which you are keeping the asset. So this is again a short thing here. This video, like statement of comprehensive income, the structure, why do we show other income, what is the difference in revenue, other income, and OCI. That's a very interesting video you should be watching. I have some 30 minutes explanation, because I know that many times people are doing financial reporting, but they don't know the purpose of financial reporting. This income statement is the first financial statement. What is the structure and what line items do we have? What is the philosophy behind this structure? So if you get time, do watch that video of statement of comprehensive income explanation. I honestly spent almost 30 minutes on explaining all these line items. Not only that, okay, this is here and you should remember it, but with a purpose, with the logic. Just like I said that, why do I? So I don't like, that somebody tells me put it there. I always ask, why should I put it there? So when I say revaluation model or fair value model or cost model, you should ask why cost model or why fair value model, and why in the P&L and why in the OCI. So I explained to you in the P&L, because IAS 40 was your decision as a manager, for it was not needed in the business in any case. You just purchased it for, considering it that it is going to give you some benefit. So it was your decision. Any gains and losses, they belong to you. And if they belong to you, it means that they, as a manager, they should be putting here. IAS 16 is something which is unrealized. We are not going to sell it. It may go up, it may go down in future. By the way, go down, which means impairment. So we have a separate lesson for impairment. That's not the topic of this session today. I think I'm finished with this thing. Whatever I wanted to make a comparison between 16 and 40. If you have any comments, just ask the comments and I will try to answer. So that's all with this thing. Thank you very much.